Hi, I'm Chris Levy, technical partner at Aquila Super. Look, next up in the series of topics to try and make your lives easier as accountants dealing with self-managed super funds and the audits associated with that. I'm going to be talking about the wind-up of self-managed super funds. Now, in the SMS industry, there's all sorts of complicated, interesting topics, in-house assets and valuations. But of late, a lot of the questions I've been getting haven't been so much about that. It's more funds are getting to the end of their lives, and accountants are struggling a little bit as to how to do the accounting for it, what some of the steps are involved. And they're coming to me as the auditor to say, look, we want to do this correctly, and there's the concern that they're going to get some sort of compliance breach if it's not done in the right way. So yeah, winding up self-managed super funds. I guess the first step in the process is, of course, the client will typically convert all the assets into cash. They may have already sold a property; it's all in cash. It's ready to go, and the accountant will generate a sort of an interim accounts to kind of get the member statements, or do a really good sort of back of the envelope type analysis and work out what the member accounts roughly, or the member balances roughly are. And then the majority of those balances will be rolled across or paid out as lump sum, or they'll basically leave the fund. And so what you're left with is, what the account's left with is a tiny balance that's in the bank account, which is it's there to pay tax, it's to pay the accountant and the auditor, or it's to even receive a tax refund before the fund is completely wound up. And so the accountant comes to me and says, well, look, I want to have the balance sheet to be all nils, and that's really what you need to do. If you're saying that the fund is going to be wound up, you can't really be having any member balances there. The member benefits or the equity section has to be zero. In my best practice is that all the rest of the balance sheet are also all nil, but I have seen some balance sheets where they will say, for example, include tax liabilities. They will include a little bit, the bank account, but the net of the member balance is still nil. And look, it's not ideal, but that still kind of works, I guess. But yeah, what you can't do is you have an actual members balance there, because if you do, technically speaking, the fund isn't wound up. So yeah, it's critical to just account for that correctly. Now, the next step is or the next sort of question is, the accountant says, well, look, how can I make it all nil if there is actually still liabilities, there's still a bank account? And look, you can do that through the use of outstanding checks and deposits. That is, it's and by doing that, you could sort of remove those last little assets on the balance sheet and turn them into nil accounts as well, even though practically it's happening after the date of the wind up. Look, is it correct? It's practically speaking, it's okay. There's no losers. The ATO's happy with that. There's provided you're not hiding income or writing off income that should be declared, and that's rarely the case. There may be some bank interest, but there's also some bank charges as well. So yeah, generally speaking, using outstanding checks and deposits is typically fine. So that's how the financials should be given to us. I guess in terms of the audit, what are we looking for? Well, look, we generally speaking, if you've got the accounts to that sort of stage, we're generally happy to issue the final audit opinion. If the outstanding bank account is significant, it is material, we may actually sort of give audit clearance to say, yeah, look, this is fine, but we'll hold out actually handing over the audit opinion until you've actually, lodged the tax return and paid out the last little bit of cash in the bank account, and the fund is technically closed. But for the vast majority of funds where there's only a small amount left in the bank account, we can typically issue the audit opinion straight away. Speaking of that last bit of cash, what tends to happen is that the trustee will after the refunds, after paying expenses, there's always like a few thousand, it seems. What do you do with that? Now, most clients will generally pay those lump sum. They some of them do roll them over, but it's such a small amount, it's not worth it. I guess the only issue is that if the the members in the fund being wound up are not at retirement age, they haven't satisfied a condition of release, you can't just pay that to them. That is actually a breach. Now, look, is it material? Is it going to result in a contravention report? Look, it may be under threshold, so they may, they'll cop an obviously management letter, item from us and say, look, you have breached the SIS Act. But if it's fairly small, we don't do anything more. But I'm generally not a fan of that. But look, you need to consider what you want to do with that, with that last little bit. And look, the final point I want to make in relation to these wind-ups is the use of SuperStream. Most accountants understand it. Most accountants are now using SuperStream to roll over, particularly the main part of a member's benefit to another super fund, but some aren't. We are still occasionally seeing people not using SuperStream. And look, be aware, you don't actually need to use SuperStream if it's a in-specie rollover. But if that's not the case, and it's shares and other stuff plus cash, where you are required to use SuperStream, look, it's basically often it's a breach. Typically the amounts involved are such that it is going to be a contravention of a material contravention of the SIS Act. It will lead to a contravention report. I can't. Obviously, you want to try and avoid that, but I have actually seen some instances where accountants and the trustees goes, look, they don't have we're not using specialised super software, and they will make a sort of a decision, almost a commercial decision. Say, well, look, yes, I know it's bad, but once the fund's closed, what's the ATO going to do to me? Now, obviously, I'm not a fan of that. They could actually penalise you. Not that I've seen that happen. I guess in that instance, if that's what you want to do, look, at the very least, do a rollover statement, have all the documents from the receiving fund, and the receiving fund's typically a self-managed super fund, another self-managed super fund. Have all the documents there to prove that the money did in fact make its way to there, so that when we do the contravention report, we can actually tell the ATO that. But yeah, look, I mean, just be mindful of that. But yeah, look, that's basically it. Winding up self-managed super fund, very straightforward, but it can feel like it's difficult, or potential dangers. So hopefully that's useful. Thank you very much.